So today we're going to take a look at the most talked about stock this week on the UK stock market, which was Watches of Switzerland. As you probably saw, they came out with a profit warning and that led the stock to drop 36%. So today I'm going to tell you if I think Watches of Switzerland is a buy and if I will be buying the stock. So I hope you enjoy it. Hit that like button and let's get started. So you probably saw yesterday that Watches of Switzerland was down 36%. That means it's now dropped under a billion market cap at 889 million and now currently trades on 8 times earnings. But obviously, because it's going to be a profit warning, that earnings will increase, or the PE will increase because the earnings will decrease because of that profit warning. Now, obviously in the last year, it's been a very tough time for Watches of Switzerland, down 60% in the last year. So this has definitely missed out on the market rally that's been going on. Now, if you don't know what Watches of Switzerland is, then I'm guessing you live somewhere in the countryside because there's definitely one of them in every big city in the UK. Watches of Switzerland is a British retailer of Swiss watches with 16 stores in the United Kingdom. It's probably worth putting in there that one of the big plans for the company is actually to expand into the US, which has actually been showing pretty good growth. So when you go past one of these stores, you'd probably see that they have mainly Rolexes, but they offer a couple of other brands in there. One of the new additions the company actually has is its pre-owned business. And if you ever go past the stores, they're always quite nice looking high-end stores. Now, the luxury watch market is growing 6.4% on a CAGR basis, or is forecast to grow from 2023 to 2030 on a good growth rate. Obviously, the luxury watch market has seemed to have a boom in the last kind of couple of years because people have had a lot more money to spend, more disposable income. But what we've seen with a lot of the luxury goods in the last, especially 12 months, is we've seen consumer spending get a little bit tighter. People don't have as much disposable income as they did 2 years ago. Obviously, costs are going up, and that kind of middle class that might go into that luxury watch market are kind of cutting back on that, and we've seen a lot of luxury products get hit, whether you look at Louis Vuitton, for example. I think it was Hugo Boss that put a profit warning out the other day. Burberry put a profit warning out the other day. We've seen a lot of these high-end products have a pretty tough time at the moment, and my feeling is because of the inflation and cost of living impact that we've seen, and I think we're seeing less of that middle class go in to that higher-end luxury market, and that's what's really affected these sort of companies at the moment. Now, a good chunk of Watches of Switzerland's revenue actually comes from Rolex, and Rolex is a very demanded product. It's actually got a waiting list. It's one of those, like a Ferrari, for example, where it's an in-demand product and they're able to control the supply and the prices a little bit. However, saying that, the problem is that there can be swings in the market pricing. Now, this is what sometimes puts me off investing into businesses, is that for me, I don't really have great knowledge in the luxury market space of watches. So because of that, I, as a retail investor, one of the big things that I always go by, and as Peter Lynch says, you invest in what you know. If you want to beat the market, if you want to have the edge on the market, you've got to buy things that you know, and you can see changes that are going on in the industry and in the category. For me, I could not tell you if Rolex prices are doing well, if they're high, if there's low, if there's demand there, where they're going to be in the next year, 2 years, 3 years. I think they will be higher, but for me, I don't really have much expertise in this area around this luxury price of watches. So that's one thing that puts me off, is that for me to be successful as a retail investor, I've got to have the edge. And I've got to say, with Rolex prices hitting a low, I would guess to potentially be at low right now, but that's something that I think about when I do look at Rolexes. But it is good that they are able to control the demand. Now, the problem is that Watches of Switzerland are a supplier. They're not actually the manufacturer. If it was actually investing into Rolex, you've kind of got a moat there. You've got the branding power. It's like Ferrari. When you go buy Ferrari, you're actually owning the brand Ferrari. When you do go buy Watches of Switzerland, you're not actually owning Rolex. You're actually selling a company that sells Rolex. And the question comes around the moat point of view. From that point of view, is that, is there much of a moat here? And we actually saw this a while ago where there was a fair drop in the share price, which I thought was slightly overdone, but we saw that Rolex actually made a acquisition, and Rolex actually went and bought another watch retailer. Now, with Watches of Switzerland getting a good chunk of their revenue, I think it's around 60% of their revenue from Rolex, this spooked the market and spooked once again the moat around Watches of Switzerland, because if Rolex are going direct to a supplier and they limit the supply to Watches of Switzerland, and because they bought a retailer, are they going to give them priority? Now, there was a RNS put out from Watches of Switzerland saying this is not going to impact their sales, and it was just something that Rolex had to do. They are not looking to move into the actual distributor, seller, retailer space of this. It's just something that had to do with the founder stepping away. So yeah, I mean, you can take that how it is. Do you trust this RNS? Do you think they're telling the truth? Or does it once again kind of question the moat that you have around this sort of business? Now, if you actually go on one of their Q2 trading updates, which was on the 7th of November, so you're only going back 2 months now, you would have got no idea that there was going to be a profit warning. If you look at the statement from the CEO, he said that there was an improved Q2 trading performance. Group revenue was up 5%. They said that UK and Europe was in line with prior year, so we can see here a lot of the growth has been coming from the US because that was growing at 11%. But on the outlook point of view, there was no change. The guidance does not change at all, and it said their guidance does not reflect any expectations of an improvement here. And then we go to the half year results, which is only 1 month ago. So this was on the 7th of December. So same again, US growth is good. The consumer environment in the UK continues to be more challenging, which we saw in the last trading update, and UK and Europe revenue was down 4%. So we did see a little bit of weakening going on in this environment, but they said that this was impacted by the timing of product intake in Q1 financial year 24 and a temporary showroom closures for refurbishment. So they're saying that this was not due to any weakness. They're saying that they're seeing this because of products that were not for sale and a showroom being closed. So same again, there's no kind of hint here that they're seeing weakness from management. Now the numbers have got slightly weaker, but they're putting nothing down to a slowdown. And it said here that for financial year 24 guidance remains unchanged based on our trade improvement and large showroom refurbishments. So this guidance was given 1 month ago, no change at all to the guidance. Now, on this actual update, the stock was up at the time. Now, if we actually go from the trading update that's actually caused the drop in Watches of Switzerland, where it's now gone down 36% of this update, they said that despite a positive start to the earlier part of Q3, Watches of Switzerland then experienced a volatile trading performance in the run-up and beyond Christmas. And if you look at their new forecast figures, they are now expecting slower growth from 8 to 11% down to 2 to 3% on constant currency revenue. So that's quite a big downgrade. EBIT margin was to be in line with financial year 24. That's now to be in an 8.7 to 8.9 range. So that's going to be lower than where we were in financial year 23. And also if you look at the operating cash conversion, they said 70% weighted towards H2. And now that's gone to 50%. The group also said they're going to announce a Q3 update on Thursday, the 8th of February. Now, from my point of view, from management point of view, they've got to see if they haven't changed the guidance and the guidance here, and then they've done this. I mean, they must have seen in this Christmas period a really bad Christmas period. If they've kind of showed no signs at all to downgrade this fast, it must have been a weak Christmas period, or either the management was a little bit slow to reflect a slowing demand, and then they've come with a big downgrade. And for me, I look at the share price drop, and do I think it's justified to see that drop? I think so. I look at this here, and the revenue guidance is a massive cut. There's a big difference between growing nearly double digit to 2 to 3%. Your profitability is going down, and that's what I mean about early, is that maybe at the moment you go, well, 8 times earnings, it's probably not too bad, but you've got to now start factoring that the profitability is going to go down a little bit here. Now, obviously in the short term, there might be buyers that go, you know what, I'm going to buy in here, but there's definitely issues with the company, and you are changing your valuation big time based on those sort of numbers that are out there. Now, my other issue is with Watches of Switzerland. They actually have gross margins of 13%, which is really hard to make money on them sort of valuations. And you might go, well, 8 times earnings, obviously not probably the correct earnings here, is cheap. But the problem is we don't really have much to go on, because if you actually look at the P ratio of Watches of Switzerland, they've only really had a P ratio since 2020. Before then, the company wasn't really profitable, and since then it only IPO'd in 2019. So it looks cheap maybe on a P ratio, but there's nothing really that we can compare to, because if we go on the past performance, for example, you can see here that previously 2014 was loss-making, 2015 loss making, 2 million in profitability in 2017, which isn't much on a 900 million market cap, 0.4% profit margins. We got 281k, 5 million in 2019, same again, 50k in 2020. The company really didn't actually start making serious amount of profitability since 2021. So from a historic data point of view, there's not much on a profitability point of view data that we can use. And once again, it's, can the company stay significantly profitable? Has this company benefited a lot from the online boom, people having so much spare capital? Is this company going to be able to maintain profit margins? And what we are going to see in the coming few months is, once again, the company kind of looks like it's peaked at 8% profit margins, and that's going to start slowly going lower and lower down. So from a valuation point of view, it's really hard to work out what it would normally trade at a PE ratio, because we haven't really got much data. And from a profit point of view, we haven't really got a company here that's proven profitability. Sure, they've had good amounts of profitability in the last kind of 2 years, but before that, we haven't really had a company that has done decent profitability, which is a little bit of a worry. Now, financial health wise, it's actually quite a healthy business. If you look at the company here, they've started to pay down a lot of the debt since the IPO. Probably one of the reasons why they went public is because the company was very heavy on debt, because it was so heavy loss making. But they have paid down some of the debt here, and now it's a pretty healthy balance sheet. 68 million in debt. On a cash point of view, they've got 86 million. So it's not too bad from that point of view. There's no dividend here that you'll collect from the business. And from an insider point of view, I'll be interested to see if there's any insider shares being picked up in the coming few days to try and create a bit of a bottom in that stock. But there was some buy-in on the 1st of September, and unfortunately since then, the lead director that did pick up some shares and a member of the board, they were picking in the £5 range. I mean, their shares have fallen down massively since they bought some shares. So let's have a look at some numbers together and see if this is worth buying from my point of view. So no share buybacks currently on the company, and like I said, there's no dividend to factor in here. So we are totally going on share price appreciation. Now, I put revenue growth of 2, 3, 4%. Now, a few people might argue that they might recover from growth, but when you've got a company in this sort of situation, I want to make sure there's big risk to reward here, because like I said, there's the uncertainty around a proven valuation, and there's also the uncertainty around, can they deliver profitability? Profit margin, I have factored in the lower profit margin. Like I said, we've got no concrete of historic profit margins, so I've dropped that down to 3, 4, 5%. And from an earnings point of view, I've put 10 times earnings in. The reason why, same again, I have no historic valuation to go off. And as well as that, if you're a company that is revenue growing 2, 3, 4% and a profit margin of 3, 4, 5%, I don't think you're going to trade at that higher multiple valuation or the market average valuation. On the low side, we've got downside of 41%, on the mid side, downside of 17%, and on the high side, 6%. So right now, I look at this here and I'm not really seeing much upside, assuming a margin of safety. Now, someone that is more knowledgeable in the space or in selling Rolexes, watches, maybe has more insider information on watches in Switzerland, you might go, well, yeah, they're going to have these tough numbers for maybe this year, but they will recover in the next coming 2-3 years. So you might start factoring a little bit more growth in, maybe a little bit more profit margin. So what I've done now is I've updated that the revenue growth is 4%, 5%, 6%, and the profit margins go up to 4, 5, or 6%. Now, you do have upside here of 28%, 66%, and you might even get the 100% return in the next 5 years if it gets back to 6% revenue growth and a profit margin of 6%. And that's what we look for. We look for at least 100% return here, but that's a big assumptions. To see that go back up to 6% revenue growth and 6% profit margins, it's a big assumption from my point of view. So I look at that and I'm just not seeing the risk to reward. Now, if you are confident that this will go back to good amounts of growth and good amounts of profit margin, I think you buy it. But from my point of view, I'm looking at this and I'm just not seeing the risk to reward here. I'm seeing a company that has to return to profit margins that are very good, that we are unsure if they can do. That's assuming that they go to a 15 times earnings, which once again, we've got no historic data of what they normally trade at. And with the profit margins, decent growth as well. And like I said, for me, I'm seeing a lot of risk to reward here where you're assuming a big recovery in the financials. But the big thing that I would also be taking on is that this isn't an area that I'm confident going in. Like I said at the start of the video, is that for the luxury watch market space, as an investor, as a retail investor, I've got to buy what I know to have the edge on the market. And I don't have much knowledge in here, so I won't have the edge on the market. I'm not sure on the moat side of it. I'm not sure on profitability, what growth they'll get to. I'm just seeing too many risks for me personally. And for me, it's one that I'm going to avoid. Like I said, if you think they can recover on the profit margins and the revenue, you might only get to these higher numbers of 6+% revenue growth, 6% profit margins. You're going to make money on this. But from my point of view is that I don't need to buy every stock in the market. I don't want to buy a stock that I'm not 100% on. If I'm not 100% on it, there's plenty of other stocks out there for me, and I might miss this one and it might be a good opportunity. But for me, I'm just not seeing that margin of safety from my point of view to put my money in here. So yeah, for me, I'm going to give this one a miss. I think there's too many risks there at the moment. But if you are confident on a recovery, you might fancy this one. But that's my thoughts on it anyway. So I hope you enjoyed the video, guys. Have a good weekend. If you're on Patreon, I'll see you for an exclusive video on the weekend or the stock request. Apart from that, guys, see you in a bit.